Welcome back to our show. I'm Daniel Razvi. I'm a tax attorney with Higher Ground Financial Group, and I'm here with my father, Imran Razvi.
Yes, I love working with my son. It's a great to be able to do that together, and we enjoy working. And we find lots of interesting things to talk about. So one of the things that came up just recently is we had a client. We did a risk, fee, and tax analysis. We do that.
And how do you find out where we can do that for you?
riskfeestaxes.com.
riskfeestaxes.com.
So you can go there, sign up. It's a free appointment. We get to find out, you get to find out a little more about us. We get to find out about you, see if we can help you. But anyways, we did this for a client who actually did this. He went to riskfeestaxes.com, signed up for analysis. We did the analysis and we found out he had a lot of money. I mean, the couple had about $16 million.
$16 million. They've had an advisor for the last 30 years and she's done really well for them. She's grown their money to a huge amount and they've been very happy and pleased. So we asked them, how do you like your advisor? Oh, we love her. She's great.
Or at least one of them said that.
Yes. But they generally, even the other spouse that it's not like they're best friends, but they do appreciate, both spouses appreciate that this advisor has grown their money. So first of all, we asked them, okay, has this advisor grown the money by more than what the market would have done? And they don't know the answer to that. And it's really hard to tell unless you go back through every year of all their contributions they've ever made. But the studies show 95% plus, I think, of all financial advisors do not beat the S&P. So if this couple had just put the money in the S&P,
they're a lot of money or more.
They may, in fact, likely did or would have had more money at the end than what they had through the advisor.
So what are you getting at? I mean, you put it with the advisor and you're missing something or you're losing it. What are you losing?
Well, you're losing the fees that you're paying the advisor. And in many cases, the fee can be a huge, huge factor. I mean, a lot of people pay 1% to their advisor. If you're on this, listen to this program, if you have an advisor, it's very likely your advisor charges 1% per year or has said that they charge you 1% per year.
And many times it's 1.25%. Or even 0.75, 0.85. I mean, the advisor can charge whatever they want.
Did you know, you mean fees are negotiable?
Absolutely negotiable. And it really depends on what you're getting. Are you getting the value for it? Then you decide whether you want to pay that. And usually if you have more money under management, if you, let's say less than 500,000, you pay a little higher fee. If it's more than 500,000, you pay a little lower. When you get to $1 million, you pay even lower. But
that's not necessarily the way we do business here at Higher Ground, but that is the industry standard. Right. Is the more money you have with somebody, the less percentage they take.
Because they have more of your money, they're going to make more money anyways. And the key is they're going to make money whether the market is up or down, they're going to get that fee.
Okay, exactly. So this client came to us and we did the risk analysis. We found that they're exposed to a loss that could be $5 or $6 million just in the next 6 months if the market starts to take a dive. And over an actual, lengthy bear market, they could lose over $8 million because that's more than half their portfolio if there's a crash similar to 2008. And they said, well, I said, is that going to bother you? And they said, well, yeah, it would bother us. We've worked hard for this money. We want to keep it there. We want to make sure our kids receive a lot of this money. And we do have a lifestyle to keep. I mean, you can probably imagine somebody that has accumulated that kind of money doesn't maybe spends a little more than the average person as well on their lifestyle. So we've counted up too. Well, go ahead.
So they had enough. And they're still taking risk.
And they're still taking risk. So I said, why is it not in cash? I mean, you've worked hard for this money. Why do you have market risk? Oh, well, to grow it. But why? And what is the purpose of the growing money? And they said, well, we've never thought about that because for so long it was, we need to make sure we save enough to retire. Well, we accomplished that. And 16 million is plenty for that. So we accomplished that a long time ago. So then we were saving, make sure our daughter is going to have a great inheritance. Well, we accomplished that. She's going to have millions of dollars. So what else is there? I don't really know. And this is their words to us. I don't really know. And everybody thought about that. What is the purpose of risk? And this is very, very important. Risk needs to have a purpose. The purpose of money that's in the market or the money in your account, the money cannot have a purpose to grow. Growing is not a purpose. It is a means toward a purpose, an end, a goal that is going to be used because the purpose of money is to be spent on something. Eventually, somebody, someday, somewhere will spend that money. It might not be you. It could be you, could be your kids, could be your friends, could be your charitable beneficiaries, and worst of all, it could be the government. But somebody someday will spend that money. Yeah. It's not going to just continue to grow forever. Even if you have multi-generational wealth building in mind, someday someone is going to receive that money and use it. So you need to have a purpose, and the purpose needs to be identified, articulated. You should write it down. This is why I'm growing my money.
And it's a change from time to time. As you get older, things change. You have different priorities. So your purpose can change, and that's fine. But you should have a purpose. Without a purpose, then why are you even playing?
And especially, why do you have money in the market? Because the market can go up, yes, but it can also go down. And if you articulate and you write down your purpose, this is my purpose. For many of you listening to the program, your purpose is retirement. I want to make sure I have enough to retire. Okay, what if I told you today you have enough money to retire, you don't need to grow anymore, but you do have enough today. However, if the market crashes on you, you have to work another 10 years. If I guaranteed that to you, and you knew for a fact that what I was telling you was the truth there,
would you want to take that risk? Really wait, keep it in there, even though you don't need it. But then if the market takes a dive, you got to work 10 more years.
Because many of you, if you think about how much you're spending every year, it'd be nice to continue to spend the same amount in retirement. You probably don't want to double or triple your spending. Maybe you do. Maybe you'd love to do that, but not everybody can think of an easy way to just spend a whole lot of more money, without a lot of intent behind it. So that's not going to really change your life if you have more than you need.
Right.
But if you have less than you need, that will change your life. It will require you to take some big cutbacks. And that's why a lot of advisors say, well, you'll be in a lower tax bracket in retirement. Don't worry about taxes. But it's not a good thing to be in a lower tax bracket in retirement.
That means you're poor. You don't have enough money. Why would you want to be in that tax bracket unless you've done proper tax planning? Now, many of our clients are in a lower tax bracket because they've done the tax planning. They have higher income, but none of it's taxable.
Exactly. So the only reason you would want to be in a lower tax bracket is if you also have higher income at the same time.
Right.
Most people, when they're in a lower bracket, that means they have lower income, and that's not something you should strive to achieve. So this client came to us for those reasons. They weren't really thinking about fees because they didn't realize that they could be at a better deal, and we'll identify that in a second. They knew they had a risk issue. They knew they had a tax problem, especially because their advisor had told them time and again, I don't give tax advice. I don't give tax advice. They even asked her questions about taxes, and she said, go talk to a tax attorney. So they did. They hired me, the tax attorney.
And many times they'd say, go talk to your accountant or your CPA. Well, the accountant and CPA are reactive. A tax attorney is proactive. What the tax attorney does is put together a plan going forward on how to minimize your overall tax burden, not only for you, but your family, your beneficiaries, everybody, and try to pay the least amount. It's not cheating on taxes. It's paying only what you absolutely have to pay. And so there's three killers, right? Risk, fees, taxes. That's our website, riskfeestaxes.com. So they came to us about the taxes, and we showed them about the risk, and they never thought about that. And then we wanted to say, okay, so how much are you actually paying in fees?
So we found out that this advisor had not actually lowered their fees when they got to this level of wealth. Like, in fact, she'd raised their fees recently. And so she's now charging 1.4% on their money. Now, 1.4% doesn't sound like a lot. And, but it gets worse from there because they also were paying expense ratios for the mutual funds. So not only was she paying 1.4% to a management fee, but they were also paying another 0.3 or 0.4% or whatever in expense ratios.
So let me explain what that is, because some people might not know. You're paying a fee to your advisor, and then the advisor actually puts mutual funds in your portfolio. When they do that, a mutual fund is managed by somebody else, another mutual fund manager, and that mutual fund manager has to get paid, so they charge a fee internally to the mutual fund. And then they also have 12B1 fees, and some of those fees come back to the advisor as additional revenue. So that all adds up. So most people think about, well, I'm just paying my advisor this 1%, or in this case, 1.4%. But then you have another 30 basis points on top of that. So now you're paying 1.7%, and the advisor's not even doing all the advice.
So we counted up with the exact account balances they had, the exact amount they were paying in fees. This couple on their $16 million portfolio, they were paying $283,000 every single year in fees.
Going up.
Going up because the market's been going up. And if the market goes down, they pay a little bit less, but they still pay hundreds of thousands of dollars in fees.
Yeah, and that brings me up to another point. You hear these advertisements all the time. We make money when you make money. Is that really true?
Well, it's true, but they also make money when you lose money.
Yeah.
So they make a little bit less because it's a smaller point.
But they're still going to make money. You pay fees whether the market goes up or down. So don't fall into this trap. We make money when you make money. You're going to pay fees regardless.
So we told them, look, this is how much you're paying $283,000 every year in fees. That's your tax bill, because this couple had high enough income. They were paying $280,000 in taxes. I said, that would have paid your taxes last year, but you paid it to your advisor. And they were floored. They were shocked. See, how in the world are we paying this? I mean, doesn't everybody have to pay the fees? And I said, no. I mean, you can negotiate. First of all, any advisor in the country would love to take you on as a client, and you could probably name your price for the fees because a $16 million portfolio is a substantial amount of money. But I said, more than that, what is justifying that high of a fee? Because it takes the same amount of money, same amount of time to trade $300,000 of Apple shares versus $3 million of Apple shares. It's one button you click, sell. Like you can make a trade for hundreds of thousands or tens of thousands or millions of dollars in one button click. So it doesn't cost the advisor any more time to manage your money compared to somebody who has 1 million or 2 million. So why should you pay that much more?
So we decided, okay, let's find out. Is this advisor doing something drastically different or more work that really constitute this much of a increase in fees? I mean, what are they? Maybe they're getting something much better than what's out there. But you know what? They're not.
No, we found out they're taking about the same amount of risk as the average person, which is too much in retirement.
And it's not more trades. It's not 3 million shares of different shares. It's a lot of the same stuff. It's almost the same thing as somebody who only has a couple 100,000 portfolio.
Exactly. And the most important thing is they were not getting the tax advice. So we were able to put together a plan for this client. We reduced their fees by hundreds of thousands of dollars a year. We reduced their taxes significantly. They're going to save not 1 million because they have more than the average person. They're going to save several $1 million of taxes just in the first few years of working with us.
It's close to $8 million in taxes.
Exactly. And then they're going to have significantly more optimized portfolio because they reduce the risk, fees, and taxes. They have money protected from loss. They're always going to be able to meet what they need with the money. So again, go to our website, find out how we can save your risk, fees, and taxes. The website is riskfeestaxes.com. It's Higher Ground Financial Group. Again, this is Daniel and Raz. We talk to you about how to minimize your risk, fees, and taxes.
And this is a free appointment, no risk. And you don't even have to pay for gas. It's online. All right. See you soon online. Take care.